In your hand right now, you might be holding a 1 rupee coin. Stainless steel, nickel-plated, weighs about 3.76 grams. In 1947, when India gained independence, 1 rupee could buy 13.3 grams of silver. Today, that same rupee buys you 0.15 grams. That's a 98.9% loss of purchasing power measured in metal. But here's what's strange. The government of India just banned the export of 67 tons of gold that was already purchased, already paid for, already in transit to refineries in Switzerland. 67 tons. That's $4.8 billion worth of metal that Indian citizens legally bought, that dealers legally sold, that customs legally cleared. Until March 18, 2026, when the Directorate General of Foreign Trade issued Emergency Circular 12/2026 at 11:43 p.m. local time. No parliamentary debate, no advance notice, just an administrative order that turned legal commerce into contraband overnight. This is not about India protecting its gold supply. This is about the global, physical gold market running out of inventory to settle paper promises. Here's what they're not telling you. Between January 1st and March 15th, 2026, Indian gold imports surged to 287 tons, a 340% increase over the same period in 2025. The Reserve Bank of India watched this happen. The Ministry of Finance watched this happen. SEBI, India's securities regulator, watched this happen. And for 74 days, they did nothing. Then, on March 16th, the London Bullion Market Association reported a delivery failure on 12 tons of gold contracts. Not a delay, a failure. The metal wasn't there. 27 hours later, India banned gold exports. This is not coincidence. This is recognition that the physical supply chain just broke. At 9:15 a.m. on March 17th, gold dealers in Mumbai's Zaveri Bazaar reported premiums hitting 18% over the London spot price. By 2:30 p.m., premiums reached 23%. By market close, 28%. When you see premiums move 10 percentage points in 6 hours, you're not watching normal supply and demand. You're watching a scramble for physical metal because someone, somewhere, cannot deliver what they promised. The official story is that India needs to preserve foreign exchange reserves and maintain financial stability. The data shows something different. India's foreign exchange reserves stand at $648 billion as of March 2026. Gold imports of 287 tons over 10 weeks represent less than 1% of those reserves. If this were about protecting currency stability, the ban would have come in January, when import volumes first spiked. It came in March, after London reported settlement problems. The mechanism works like this. When you buy gold through most channels, ETFs, unallocated accounts, futures contracts, you're buying a promise that somewhere in some vault, physical metal backs your claim. The London Bullion Market Association estimates that for every ounce of physical gold in allocated storage, there are 92 paper claims against future delivery. This worked for decades because less than 2% of paper holders ever demanded physical settlement. The system runs on the assumption that you'll sell your paper claim to someone else before delivery date. But something changed in Q1 2026. Settlement demands hit 8.7%, the highest rate since records began in 1987. When 8.7% of 92 paper claims try to convert to physical metal, the mathematics become impossible. You cannot deliver 8 ounces when you only have 1 ounce in the vault. The London Bullion Market Association has two choices: admit the shortage publicly and watch the remaining 83.3 paper claims rush for the exit, or quietly restrict the flow of physical metal through administrative measures. India's export ban is the administrative measure. By preventing 67 tons from leaving the country, India effectively keeps that metal available for domestic settlement demands that are coming from Indian investors who are increasingly skeptical that their paper gold holdings represent actual metal. Paper can be printed, metal cannot. And when the ratio between paper claims and physical metal reaches 92-1, every percentage point increase in delivery demands creates systemic stress that propagates through the entire settlement chain. This is where the lie becomes unsustainable. The divergence between paper and physical is not a premium, it's a warning. In Mumbai, you're paying 28% over spot. In Dubai, premiums hit 31% on March 19th. In Singapore, 34%. These are not transaction fees. These are desperation premiums paid by people who understand that possession is different from a claim to future possession. The Shanghai Gold Exchange reported something unusual on March 14th. For the first time in its 19-year history, the exchange showed negative lease rates on physical gold. This means holders of physical metal were paying borrowers to take their gold for short-term loans, the opposite of how lending normally works. Why would anyone pay someone else to borrow their asset? Because they need that gold to be classified as in transit rather than in storage to avoid triggering delivery obligations on their paper positions. When you see negative lease rates, you're watching institutions cannibalize their physical holdings to maintain the fiction that their paper obligations are backed by metal. This has only happened 4 times in history: October 2008, August 2011, December 2015, and now March 2026. In each previous instance, the negative lease rate preceded a major settlement crisis within 45 days. At 3:42 a.m. Eastern, on March 20th, the Federal Reserve activated its Emergency Liquidity Facility for Precious Metals Dealers, a program that hasn't been used since 2009. The facility provides dollar loans to bullion banks experiencing temporary liquidity stress in their metal settlement operations. The Fed injected $3.2 billion in the first 18 hours. Temporary liquidity stress is central banking terminology for "we cannot deliver the metal we promised and we need cash to buy time." CME Group, which operates COMEX, the world's largest gold futures exchange, announced on March 19th that it was increasing margin requirements on gold futures contracts by 40%. This is the third margin hike in 6 weeks. January 28th, 15% increase. February 12th, 22% increase. March 19th, 40% increase. When exchanges raise margins this aggressively, they're not managing normal volatility. They're trying to reduce the number of contracts that might demand physical delivery. The mathematics are straightforward. At $2,750 per ounce, a 40% margin increase means a trader needs an additional $1,100 in cash for every contract they hold. COMEX open interest in April 2026 gold futures stood at 487,000 contracts as of March 18th. Each contract represents 100 ounces. A 40% margin hike across 487,000 contracts forces traders to deposit an additional $5.4 billion in cash or liquidate their positions. Most will liquidate. That's the point. Fewer open contracts means fewer potential delivery demands. But here's the trap. When traders liquidate long positions in futures, they often buy physical metal directly to maintain their gold exposure. So the margin hike that was supposed to reduce delivery pressure actually increases physical buying pressure. This is what a system looks like when every intervention creates the problem it was designed to solve. JPMorgan Chase reported in its 10Q filing on March 15th that its precious metals derivative exposure increased to $287 billion notional value in Q1 2026, up from $198 billion in Q4 2025. That's a 45% increase in 3 months. The bank's Tier 1 capital ratio is 13.2%. If gold moves 15% against JP Morgan's derivative positions, the bank faces mark-to-market losses exceeding its entire capital buffer. This is not speculation. This is arithmetic based on publicly reported numbers. When a systemically important bank has derivative exposure that could wipe out its capital in a 15% price move, and that bank is simultaneously experiencing temporary liquidity stress, requiring emergency Fed lending, you're not watching normal market operations. You're watching the early stages of a settlement crisis. While the Federal Reserve prints $3.2 billion to support bullion banks, the People's Bank of China announced on March 13th that it added 31 tons of gold to its reserves in February 2026. This marks the 17th consecutive month of official Chinese gold purchases. But the interesting number is not the official 31 tons. It's the additional 156 tons that Chinese state-owned enterprises imported through Hong Kong in February. Metal that doesn't appear on the central bank's balance sheet, but was purchased by entities that report directly to the State Council. When you combine official purchases with state enterprise imports, China is accumulating physical gold at a rate of 187 tons per month. That's 2,244 tons annually. For context, global mine production in 2025 was 3,100 tons. China is absorbing 72% of global annual mine production through official and quasi-official channels. Russia added 22 tons in February. India's central bank added 9 tons before the export ban. Turkey added 18 tons. The divergence is simple. Western institutions are printing paper claims on gold at leverage ratios exceeding 90 to 1. Eastern central banks and state entities are taking physical delivery. One side creates promises, the other side takes possession. One side has leverage, the other side has metal. Only one of these is a liability. This is not about price, this is about who controls settlement. When the ratio of paper claims to physical metal reaches unsustainable levels, the entity that holds physical metal controls whether the paper system continues to function. China is not buying gold because it thinks the price will go up. China is buying gold because it understands that in a settlement crisis, the holder of physical metal dictates terms. The BRICS nations announced on March 10th that they were establishing a gold-backed trade settlement mechanism through the New Development Bank in Shanghai. The system allows bilateral trade between BRICS members to be settled in national currencies, with gold as the balancing mechanism. If Brazil exports soybeans to India and runs a trade surplus, it receives gold from India's reserves to balance the account. No dollars, no SWIFT transfers, no Western settlement system. The first transaction cleared on March 17th. Russia sold 2.3 million barrels of crude oil to India. India paid in rupees. Russia received rupees plus 1.4 tons of gold transferred from the Reserve Bank of India's vault in Mumbai to the Central Bank of Russia's vault in Singapore. The entire transaction bypassed the dollar system completely. This has happened 14 times since March 17th, totaling 23 tons of gold moved between BRICS central bank vaults. When sovereign nations begin settling trade in physical gold outside the Western banking system, they're not making an investment decision, they're making a sovereignty decision. The West has leveraged its gold reserves 90 to 1 through paper multiplication. The East has accumulated physical metal and built alternative settlement infrastructure. Atoms versus digits, promises versus possession. The trap is now visible. If gold prices rise significantly, the Western bullion banks and dealers with massive short positions in paper gold face infinite losses. Their derivative books explode, their capital buffers evaporate, settlement demands surge. The system breaks. But if Western central banks intervene to suppress prices through additional paper selling, more futures contracts, more unallocated gold sales, more ETF creation, they worsen the underlying leverage problem. The ratio of paper to physical grows. Physical demand accelerates. Settlement stress intensifies. Every intervention designed to maintain stability creates the conditions for greater instability. The Federal Reserve cannot print physical gold. It can print dollars to lend to bullion banks experiencing settlement stress, but those dollars don't create metal. They create temporary solvency for institutions that have promised delivery on assets they don't possess. The more dollars the Fed prints to support the paper gold system, the more attractive physical gold becomes to holders who understand the leverage trap. This is a pressure valve that's been welded shut. The divergence between paper and physical widens with every administrative intervention, every margin hike, every emergency liquidity injection. India bans exports to keep physical metal from leaving the country. Dubai reports record premiums. Singapore shows negative lease rates. The Fed lends billions to prevent settlement failures. JP Morgan's derivative book swells to sizes that threaten systemic stability. The mathematics don't care about intentions. At 92 to 1 leverage, an 8.7% settlement demand rate cannot be sustained. Either the leverage ratio collapses, meaning paper claims are destroyed through defaults, force majeure declarations, or cash settlement substitutions, or the physical metal supply expands impossibly fast. Physics doesn't permit the second option, so the first option becomes inevitable. The last time a leveraged precious metals market faced this structure was March 1968, when the London gold pool collapsed. 7 central banks had been collectively selling gold to suppress prices and maintain the $35 per ounce peg required by Bretton Woods. By March 1968, the pool was selling 100 tons per week to defend the price. On March 17, 1968, the pool sold 400 tons in a single day. By March 19th, the pool was dissolved. The price peg was abandoned. Within 3 years, the entire Bretton Woods system collapsed. The mechanism is identical. A leveraged paper system backed by insufficient physical metal, defended by institutional selling, eventually faces physical demand that cannot be satisfied at the promised price. The intervention increases until the intervention itself becomes unsustainable. Then the system breaks. There is no policy response that doesn't accelerate the outcome. Raise margins to reduce delivery demands, and traders buy physical directly. Lower margins to encourage paper trading, and leverage grows more dangerous. Print money to support liquidity, and the currency becomes less trustworthy, driving more demand for metal. Restrict physical flows through export bans and administrative measures, and premiums explode, confirming the shortage. The question is not whether the paper gold system can continue to function at 92-to-1 leverage with 8.7% settlement demands. The question is how the deleveraging occurs, slowly through managed defaults and cash settlements, or rapidly through systemic crisis and force majeure declarations. Central banks are accumulating physical metal at the fastest pace since 1967. Sovereign wealth funds are reallocating from paper gold ETFs to allocated physical storage. Large institutions are demanding delivery on futures contracts rather than rolling them forward. These are not speculative trades. These are positioning decisions made by entities that understand the difference between a claim and possession. The informed are not reacting to price movements. They're observing settlement mechanics. They're watching delivery failures in London, negative lease rates in Shanghai, emergency liquidity injections from the Federal Reserve, 40% margin hikes at COMEX, and export bans in India. They're watching the divergence between paper and physical widen from 18% premiums to 28% premiums in 6 hours. The question isn't whether to panic, it's whether to understand. Markets can remain irrational longer than you can remain solvent, but they cannot remain irrational longer than physics permits. The ratio of paper claims to physical metal is a physical constraint, not a market opinion. When 92 entities hold claims to 1 ounce of metal and 8.7 of those entities demand delivery, the mathematics resolve in one direction. In your hand right now is that 1 rupee coin. Stainless steel and nickel, worth less than the metal it's made from. In 1947, it could command 13.3 grams of silver. Today, 0.15 grams, a 98.9% debasement measured in atoms. The Indian government just banned 67 tons of gold from export, not because India has too much gold, but because the global settlement system has too little. The divergence between paper and physical is not a market anomaly. It's reality reminding us that gravity still works, even in finance.